This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Tech earnings kick off. Alphabet sliding in late trade as it flags even higher spending this year in the race to build AI computing power. IBM confirming a cut to its full-year sales outlook. Tesla misses Wall Street's profit expectations for the quarter, shares falling as Elon Musk warns the company's push into robotics won't be easy. And the escalating Middle East war sends Brent crude prices higher, with inflation worries lifting bond yields.
I'm Haidi, Stroud-Watts in Sydney. Take a look at the setup for trading across Asia. And as Shery mentioned, a firm focus is really on these tech earnings. That next catalyst that's expected for the chipmaker stocks and the AI space in particular after what has just been weeks and months of whipsawing volatility and action here. But take a look at how we are shaping up when it comes to US equity index futures, looking pretty mildly to the downside on Thursday trading. Investors still weighing up these numbers from AI heavyweights, looking for that further evidence that just the sheer amount of capital spend has been paying off, is translating into growth. The Alphabet guidance, we'll get more on that in a moment, for higher capex, so we'll be really injecting a little bit more enthusiasm into this semiconductor trade that has been wobbling. Whether you're talking about the Korean market, we are seeing Kospi futures up by 1.7% there, or Nikkei futures down by 0.4%. Also, of course, watching the impact of dollar yen going beyond that 163 per dollar for the first time since 1986, but then a little bit of brief respite on the sort of changing outlook, the prospect potentially of faster hikes from the Bank of Japan, open to raising rates at a faster pace than consensus among economists. So the money markets are adding to wages when it comes to a hike by October of this year. Switching out the board to take a look at the geopolitics part of the play, right, because we continue to watch crude and broader energy and commodities prices. Brent crude last traded higher by almost 3.5%. New York traded crude up by 1.25% at the moment, continuing to really ramp up momentum to the upside after we had Houthi militants say that they're targeting 2 Saudi Arabian tankers in the Red Sea. So this escalation continues to be a distraction, Shery, but there's a lot to pass through when it comes to these tech numbers.
Yeah, let's delve into them. The first big tech earnings of the season, Alphabet shares falling in late trade as it again raised already sky-high estimates for capital spending. Others reporting after the bell include IBM and Tesla. Mandeep Singh is global head of technology research at Bloomberg Intelligence and joins us now. Mandeep, I mean, we also got a little bit of a miss when it came to search ads, but at the same time, cloud revenue just was a blockbuster surge. What's going on right now? Is it just sky-high expectations at this point?
Yeah, there are a lot of moving parts. And, you know, when you compare the Alphabet from 2-3 years ago to now, we're just talking about the cloud business growing at 82% at a $100 billion run rate, which is phenomenal. But Alphabet used to be a consumer ads company. So that's how much, things have changed for them. And, the justification for the higher capex is that they are seeing so much growth and demand on the cloud side that now they are selling their standalone TPU systems in addition to what they are selling through the cloud segment. And that's where there is a lot of runway. Their backlog exceeded $500 billion. And some people could be slightly disappointed with the sequential growth in backlog. But there's no doubt, when a company has a segment and a backlog which is 5 times the segment revenue, it's a lot of runway. And that's why you will see a big increase in 2027 capex as well for Alphabet.
Well, that's interesting, right? Because we didn't get that much visibility going into 2027. They talked about being supply constrained, which obviously is bullish for that idea that demand is going to keep going up. Do you have that expectation that, the confidence that spend will also keep going up as well?
Yeah, I mean, look at this quarter. So their capex doubled from last year. And the cloud revenue growth was 82%. And all signs are that cloud revenue growth will accelerate for the remainder of the year. They did talk about some margin headwinds on the cloud side, even though the cloud segment had the best margins since the inception of that segment. But they talked about offsets being third-party rentals from companies like SpaceX and NeoClouds, and also the fact that they are selling these standalone TPU systems. So they are like competing with Nvidia, to my mind, by selling these complete systems now to the data center companies. And so from that perspective, they are making these big investments, and it will be reflected in 2027 capex, which my number is $300 billion. I think they're probably going to go higher based on what we heard on the call today.
Mandeep, we also got the results from IBM, which some say was better than feared. But at the same time, does it just reflect all of the concerns around the software sector itself?
I mean, look, we're comparing a company that grew, low single digit. They pre-announced a couple of weeks back, and really they cut their guidance. So from that perspective, they are caught in this wave where, things really aren't going very well from a business standpoint, and mainframes is the key segment which has disappointed this quarter. But there's no doubt that they are under pressure, and they talked about software deals closing. They had some slippages, but overall, I think when you compare the two prints from Alphabet and IBM, they're just opposite in terms of the top line growth expectations.
Does that mean we're going to see further downside when it comes to some of these software companies, even ones that are as potentially defensive as IBM?
Yeah, I mean, overall, I think it looks like you will see more pressure on software and services names this earnings season. And it's really the cloud companies that should come out on top, going by, the Alphabet print. And the trickle-down effect of increased capex should benefit the semiconductor names. But I think companies still feel they are supply constrained, the ones that are at the forefront of this AI infrastructure build-out. And they want to add as much capacity as they can, at least for the second half 26 and possibly going into 27 as well.
Our Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, there with a wrap on those numbers out of Alphabet, out of IBM as well. And we're also watching Tesla. Shares are lower in late trade after second quarter profit missed Wall Street estimates, even after a strong quarter of auto sales. Adjusted earnings of 33 cents a share fell well short of the 51-cent average of analyst estimates compiled by Bloomberg. CEO Elon Musk also gave few updates when it comes to Tesla's much-anticipated robo-taxi plans and warned that scaling production of its Optimus humanoid robot will be difficult. We'll do a deeper dive into Tesla's earnings and the outlook in a few minutes with Michael Dunne of Dunne Insights, who says the company remains on a permanent high-stakes roller coaster. So it's all about tech earnings, but of course, let's not forget we still have the geopolitical consequences of the worsening US-Iran war. Bonds all in focus today as well. Let's cut through the noise. Our Bloomberg M Live strategist, Mark Cranfield, joins us now. So, Mark, what are you most focused on in terms of the priority for today's trading action?
I think a bit of everything that you just mentioned there. Obviously, the attack in the Red Sea by the Houthis on tankers there, that's a new development, which is pushing up oil prices. It's something that traders hadn't really had to deal with. They were used to problems in the Strait of Hormuz, and now we might have to take the Red Sea very seriously as well. So that's a new dimension which needs to be priced into markets and will definitely affect equities to some extent, but particularly bond markets. Bond markets are already very edgy. We have a big story on Bloomberg about 30-year yields being above 5% for the longest period since the global financial crisis, and this certainly will not help in that regard, because if you look at where the Federal Reserve pricing is in relation to inflation expectations and where oil prices are, traders are still underpricing the impact from the Fed in terms of being able to rein in inflation. So that will play out in a steeper curve, higher long-term yield. So that's very much in play as well. And as you talk about the tech sector, particularly the loss in free cash flow earnings, Alphabet went negative. That's something which has been a very big positive for markets. It's helped the Korean and Taiwanese markets as well. When they see the risk that spending by hyperscalers has gone into negative territory, that may well put a dampener on any mood that we have in Korea especially, because they may need to draw back and spend less on some of their input over the next few months and years. So that's a big question mark for markets as well. Also, the unrealized profits that Alphabet is talking about in terms of the AI investments it's made. Well, if you look at the way that SpaceX has crashed since its IPO, it suggests that valuations on AI before they come to market are really too optimistic. So again, that's a negative factor across the market. There's a lot for investors to juggle this morning. Mostly, it looks as though it's going to dampen the mood and be something which is not great for equity markets when they get going in Asia this morning.
And it really doesn't help that we're not getting sort of any clues coming from the Fed, right? Kevin Warsh's no forward guidance sort of approach. How live are the next few FOMCs going to be? And should we count next week ones as well?
It's probably too close to the July meeting to really call it a live one. It'll be surprising if they make a huge change there. What we might get is we might get more dissent. There might be more Fed people calling for action, but they're unable to agree on when the timing of that is. But it certainly means that through their messaging and through the press conference, they may well start to lean a lot more hawkishly than people are currently pricing for, which will raise the odds for the following two meetings that the chances are the Fed will have to do a precautionary interest rate hike, particularly if we get hawkish messages from the European Central Bank today. They meet later. They've already raised interest rates. They're actually ahead of the Fed in this stage of the cycle. They may well put more pressure on the Federal Reserve by either raising rates or talking about another rate hike to come from the ECB. So that's something else that needs to be factored in by the FOMC next week. Everything is shifting towards the idea that the US will need to raise interest rates this year, and it could be well before December. It could be September or October. That is certainly moving forward, and that's something you can see in the 2-year yield. People are talking a lot about 30-year Treasury yields, but if you watch the gradual increase in 2-year Treasury yields, they're the highest for a long period of time, and that's where traders are really warning the central bank, you are getting behind the inflation curve and you need to step up and do something about it quite quickly.
It's the same story for the JGB 2-year yield, right? Highest level since 1995. And now Bloomberg has learned that BOJ officials could be thinking at even moving faster to hike rates than previously expected. But Mark, I gotta ask, I mean, will this help in any way with the Japanese yen, given that it doesn't necessarily seem to be just a BOJ issue, it's an authorities, Japanese credibility issue at this point?
Yeah, exactly as you say. I mean, you can tell that foreign exchange traders are quite skeptical about the idea that the Bank of Japan will really move a lot more quickly than they have done in the past. If you look at where dollar yen is this morning, it's still around 163. We saw it dip very briefly overnight. It went below 163 for a few minutes, then came all the way back up again. So clearly, traders are not convinced that the Bank of Japan is really going to change dynamics very much. At the moment, there's some indication that the October pricing, the meeting for the BOJ in October, is looking a bit more likely than the December meeting. But even so, it's not fully priced in. It's time for the Bank of Japan, if they really want to move the yen, if the Japanese authorities are serious about all getting on the same page and changing the narrative in terms of the yen at the moment is seen as a funding currency. They need it to be seen as a currency that people want to own, not one that they want to sell. If they really want to do that, it's time for shock and awe. The Bank of Japan needs to do something really surprising. A good place to start will be the press conference next week when Governor Ueda speaks freely about what he sees going on. A good thing for him to do would be to put on the table the idea that the BOJ moved by 50 basis points, not 25 basis points. If he throws that into the marketplace, he can see the reaction pretty quickly, and that would give the central bank the idea that traders believe that they can be serious about changing it. If they keep on going for 25 basis points over a stretched period of time, they won't get to the neutral rate until 2028. That is not going to change the direction of the yen because the rest of the world is also moving up with interest rates. Differentials will stay much as they are. It's really time for shock and awe. Next week will be a good time to do it.
Mark Cranfield will be watching the BOJ decision next week. Bloomberg MLive strategist, of course, we're watching the Japanese yen. We're also watching the Korean won because we have seen incredible weakness, of course, in this economy when it comes to the currency space. We are seeing these mass exports of semiconductors helping the economy. The second quarter GDP coming in right now, but the Korean won hasn't necessarily budged that much. You can see right there, it's a surprise to the upside. Second quarter GDP growth expanding 0.6%. 1% quarter on quarter. The estimate was only for growth of 0.4%. We've had semiconductor exports, the artificial intelligence fueled chip boom that's supporting the case and the economy for South Korea. Not necessarily the blowout numbers that we got in the first quarter, where we saw the fastest growth since late 2021, but still incredible numbers for an economy, of course, that is kind of heavily dependent, Haidi, on semiconductors right now. Almost just two companies running the entire Kospi, the SK Hynix stock and Samsung.
We're starting also to see that energy story come back into the fray, right? Because obviously these companies have huge energy resource demands. What we're starting to see now is, again, the inklings of potentially another energy crisis, with oil prices continuing to gain momentum to the upside. New York traded oil continuing to rise in the early part of this trade today. Iran-backed rebels saying that they hit 2 tankers in the Red Sea. So we continue to see the escalation, particularly when it comes to the involvement of these proxies in the region. We have the details ahead. This is Bloomberg.
Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
Take a look at how Tesla is trading in the after-hour session. After the profit fell well short of estimates, we're seeing rising costs. Their earnings of 33 cents a share in the second quarter. 51 cents was the average for analyst estimates compiled by Bloomberg. So that's the first quarter of negative free cash flow in more than 2 years, burning through just about $1.1 billion. And we also saw an almost 50% surge in operating costs as well. But let's take a look at the outlook now for Tesla. Michael Dunne, who's the CEO of global electric and autonomous vehicle market research firm Dunne Insights. Michael, really great to have you with us. And I do wonder, the propensity for sort of just a huge amount of market focus on some of Elon Musk's other projects, SpaceX, of course, has been the dominant for headlines. Has Tesla taken a little bit of a back seat for this quarter?
There was a moment during the earnings call when he said something that really struck me. He said, "We don't want Optimus, that's a humanoid robot, to go haywire." What did he mean by that? He said, "I need more time." This is not a case of Tesla replacing gasoline engine cars with electric battery powered cars. It's a future in which cars drive themselves and humanoid robots do the work of people in factories and other places. So it's a jump of a magnitude he has not encountered before. And his main message today on the call was, "I need more time to get this exactly right. The stakes are incredibly high. If this works, it's going to be amazing. Need more time."
Need more time when it comes to the nascent robo-taxi business as well, because that was also disappointing.
That's right. There's always with Elon, he likes to defy investors by promising a glorious future and then delivering late. So there's promise of robo-taxis. I was recently in San Francisco. They're on the road. They're being tested. They're amazing looking. They're two-door coupes without any steering wheel, without any pedals. We haven't seen something like this before. It's all based on AI and physical AI, and he wants to make sure it gets exactly right. They're in 7 cities right now, currently in the United States, being tested. But he's emphasized that, like with the humanoid robot Optimus, we don't want these things to make mistakes. So give me more time. That's the bottom line.
You make a fair point, though. We've already talked about the Optimus humanoid robots. We've talked about the cybercabs, the robo-taxis. Full autonomous driving is the ambition, the megapack energy storage as well. There's so much going on. So is it, in a sense, unfair? Do we need to move beyond judging this company on just the standard calculus of EV sales now?
That's right. Cars as a business have taken a backseat at Tesla. If you look at their valuation, Tesla's 5 times more valuable than the next most valuable auto company, that'd be Toyota. So we're really talking about, and Elon has said this, we're an AI and robotics company. Our future is autonomous. That's where all of our chips are being placed. batteries and other businesses are good, but the real breakthrough, the gold mine, will be when autonomy is perfected.
One of the biggest criticisms and concerns over Elon Musk, even amongst his supporters, is that he's got a lot going on, right? And perhaps prone to distraction, particularly with SpaceX, particularly with, data centers in space. Do you see a point when Tesla and SpaceX will eventually merge to become one company?
That's the big bet out there. It's definitely, from my perspective, it's Elon's vision is to bring SpaceX and Tesla together and offer an array of what they call, right, these days, physical AI products and services. You've got Starlink, you have the rockets, you have autonomous cars, you have Earthlink, you have so many businesses that would revolve around this future company called Tesla SpaceX. And he's gone off to say, it will be more valuable than everything else on Earth. That's the vision. Now it's a question for investors. Do we believe him? How much time will we want to give him? Or is it a bridge too far? Has he really overstepped even his own capabilities?
How do you assess fair value then in that context?
Yes, I think that over the last 10 years, we've seen this zigzag, ups and downs, dramatic ups and downs in the stocks, but over time going higher. And that's my expectation for the second half of this year and beyond. He is not one to bet against. He is a force, like the likes of which we haven't seen in 100 years in this country. So I would not bet against him. They'll find a way to get this done and deliver.
Yeah, and I like that your top talking point is that he seems like he's never comfortable unless he's daring investors to bet against him. Elon Musk, nothing if not, ultimately always a contrarian, right? But if the EV car unit sales is, as you say, taking a backseat, pardon the pun, does that mean then we can continue to kind of expect more of a bullish positioning for companies like BYD if that's no longer kind of the main competitive priority for Tesla?
That's right. It does relieve a lot of Chinese automakers that Tesla's moving beyond the core business of cars. That's definitely true for BYD and others. At the same time, BYD has its own sort of challenges, and that is that it's surrounded by large numbers of competitors inside China, the Geelys, the SICs, the Chang'ans, who are taking market share from BYD inside China and further reducing margins. So yes, it's good news that Tesla's moved out of the picture. The tougher news is how do we make profits in an environment where everybody's all in and driving margins down month by month and week by week? What's the end game? How do we survive this endless price war and get back to making profits? That's the headache. That's the challenge in front of most Chinese automakers, including BYD today.
Yeah, lots of cost cutting going on there with BYD at the moment. Michael, really great to have you with us. Michael Dunne, CEO of Dunne Insights, with us. More ahead here on the Asia Trade. This is Bloomberg. Commodities in focus as we continue to see broad regional escalation of the US-Iran tensions, oil surging after the Iran-backed Houthi militants saying they attacked 2 Saudi tankers in the Red Sea. So watching that escalation as we see New York traded crude climbing by over 1%. Also watching gold at the moment with that dip buying outweighing inflation concerns.
Heidi, big tech earnings has kicked off in the U.S., so we'll be watching those suppliers across Asia. Of course, we got the numbers from Alphabet, for example, which was really interesting because we're seeing the downside pressure in the late session. We had this huge beat when it came to really the cloud revenue surging more than 80%. They raised also their 2026 capex capex guidance, and that's really sort of hurting the stock. People want to see whether all of this AI investment will actually pay off. What's interesting, though, is that we could see some upside from all of this. I mean, if the hyperscalers will start spending more, then the picks and shovel stocks that we have across Asia, SK Hynix, Samsung, even Tokyo Electron, parts components makers, all of them could see a little bit of a boost, right? So we're following the future space right now. We're seeing that upside in Asian stocks. IBM, though, the clear example of that downside pressure on software. I mean, the company keeps insisting that its infrastructure software is not really easily replaceable by AI, but we saw them really cut their full year guidance off after mainframe sales plunged more than 40%.
Yeah, Shery, there's no indication that that pressure on some of these software companies, even ones like IBM, are going to alleviate anytime soon, right? And as you mentioned, that pressure when it comes to the futures picture, NASDAQ 100 futures off by just about 0.5% there, really coming into how high these investor expectations are when it comes to just the extraordinary amount of spending that's been plunged into this broader AI project. And as you mentioned, when it comes to Alphabet, not a lot of visibility going into 2027. There's still a lot of confidence when they talk about the supply constraints, suggesting that cloud demand, for example, will remain robust, but perhaps investors wanting some more details. But elsewhere, of course, we've also got the Middle East conflict continuing to brew there, with these further involvement of the Iran-backed Houthi militants targeting the Saudi Arabian tankers in the Red Sea. So really opening up essentially a new front of concern when it comes to broader energy markets. We are seeing that continued momentum for New York traded crude at the moment. We are looking like some upside, though, when we get into the start of trading here in Asia, Shery.
Let's actually delve into the widening of the Middle East conflict with Bloomberg digital politics editor Romy Varghese. Romy, so Haidi just mentioned those attacks when it came to the Red Sea. What are we getting from Washington at this point, given that this conflict seems to be now expanding from the realms of just the Strait of Hormuz to other shipping routes as well?
Yeah, as you said it, we're seeing a significant expansion of hostilities. And tonight, the U.S. Central Command announced that it's launching a 12th straight night of attacks in sites in Iran. And of course, as you mentioned, we've seen the Houthis now say they attacked 2 oil tankers in the Red Sea. This is very significant. The Houthis, of course, are backed by Iran, and tankers had been using the Red Sea to get around Iran's effective closure of the Strait of Hormuz. So yes, we are seeing a significant expansion of hostilities, and rhetoric from both sides show that there's no indication of negotiating right now.
Yeah, tell us a little bit more about that, because both sides, President Trump now saying that Iran is getting hit so hard, but he's not necessarily ready for a deal. Tehran is also pushing back that any conversations are happening. So what will bring them to the table?
It looks very tough right now. I mean, the U.S. wants to see the Strait of Hormuz open. They want to see Iran stop attacking oil tankers in the Strait of Hormuz. But Iran has shown that it has a lot of leverage here, and a deal becomes much more difficult when you see Iran saying that it wants to retain some sort of control over the Strait of Hormuz, over transit through the Strait of Hormuz.
Now, Romy, we know that this conflict between the U.S. and Iran has caused many casualties, also deaths. At the same time, we're hearing that the U.S. is now spending more than $30 billion when it comes to the total cost of the conflict. Tell us a bit walk us through some of the damages that this Iran war has caused on America.
Most significantly, I would have to say the casualties. I mean, we've had 4 U.S. service members die this past weekend alone, and the United States has seen damage to its bases from Iran and the stockpiles of U.S. interceptors. They're running low, and as you said, it's actually $37.5 billion that the U.S. has spent on this conflict, and taking a step back, Iran has shown the world that it can effectively fight the United States, the world's greatest military superpower, with drones and missiles. And the Strait of Hormuz isn't even open. So this is quite a toll especially for Americans who did not support this war. I mean, they support the goal of Iran not having a nuclear weapon. That is as a fact that Trump seizes upon. But this war is increasingly unpopular with Americans in a midterm election year. And seeing the images of caskets returning to the United States is a really stark image for Americans to see.
Vikas, our Bloomberg Politics editor, with the latest. And catching up on some of the other global headlines that we're following this hour, a White House official has accused China's Moonshot of improperly using US AI models and Nvidia chips to create its Kimi K3 system. Science and Tech Policy Director Michael Kratio says the company probably acquired Nvidia's GB300 servers, which are banned from being sold to Chinese companies. The information is reporting that a US Commerce Department agency is now formally investigating whether Chinese firms like Moonshot are accessing advanced US AI chips. China says it's ready to work with the US to implement the consensus reached by Presidents Xi and Trump at their May summit in Beijing. The Foreign Ministry was responding to a Bloomberg request for comment on reported plans for an AI talks in September ahead of Xi's planned visit to the US. Establishing a dialogue on AI was one of the outcomes of Trump's trip to China. The US Senate Commerce Committee has advanced bipartisan legislation that would effectively block Chinese vehicles from the American market. The bill would ban vehicles designed for wireless connections beginning in January. Movement on the proposal, which also covers cars tied to Russia, Iran and North Korea, comes as US automakers face growing international competition. Well, the US and India are pushing to reach a final trade agreement, even as Washington issues new tariff threats on pharmaceutical products. Both countries' top diplomats have met on the sidelines of the ASEAN meeting in Manila. Bloomberg's China correspondent Mimin Loh is at the event and joins us now. So, Mimin, what did we get in terms of deliverables in these meetings, I should say, between Rubio and Jaishankar?
Well, not a lot yet, because the two sides discussed once again their interim trade deal, which has been under negotiation for more than a year. But a U.S. official now tells us it could be concluded within 3 to 4 months. Most of the sticking points have been settled except for one stumbling block, which is the Section 301 investigation into Indian goods, into overcapacity, and that could potentially lead to a 12.5% tariff on Indian goods. And you mentioned earlier, just yesterday, the U.S. had announced this 100% tariff on generic drugs being exported to the U.S. starting in 2 years' time, unless these companies move their production to the U.S. And at this point, it's not clear whether India would be able to secure exemptions as part of that interim trade deal. But the two sides also discussed some final details around this defense agreement that both sides initially agreed on last year when Prime Minister Modi and President Trump met. Some of those projects have stalled, and again, we're seeing a little bit of a rocky relations between U.S. and India, and that's why the Indian foreign minister also, when he met with the ASEAN countries, he said he's going to continue engaging with ASEAN, particularly to diversify supply chain to boost their economic resilience amid all of those geopolitical headwinds.
Rockier still is a relationship between China and the Philippines at the moment.
That's right. That's also another rocky one, where the two leaders met yesterday and lodged protests against each other after the latest incident in the South China Sea, where both sides are accusing each other's naval servicemen of attacking the other with either wooden batons or paddles from a rubber boat. And China has called it malicious harassment, while the Philippines said is an act of violence. And yesterday, the Philippine Foreign Affairs Secretary Lazaro, she also raised the issue of this AI-generated video published by state-linked media China Daily. And this video depicted the Philippines as a monkey who was being manhandled by the US and the Japanese, and is a metaphor to show how the Philippines is sort of pandering to these other powers. And she raised it yesterday again. She's previously mentioned that this was dehumanizing and disrespectful and called China to take it down. But the Chinese Foreign Ministry has distanced themselves from that video, saying that it doesn't represent the official stance. But still, the Philippine side did say that this was a constructive meeting where both sides underscored the need for peace and stability in the region. It's important the two sides engage with each other, particularly after China had sanctioned the Philippines' defense minister.
You also spoke with the Canadian Foreign Minister yesterday. What were the key takeaways?
Yes, I spoke to her yesterday and asked her particularly about China because she did meet with the Chinese foreign minister as well as the Australian foreign minister. We had seen how Canada-China ties had started to stabilize, right, as Canada recently lifted those 100% tariffs on Chinese EVs. But Chinese investments, though, still seems to be a bit of a sensitive issue. Have a listen.
We have resolved certain trade tensions with China, and we did that earlier this year when Prime Minister Carney met President Xi in Beijing. What that allowed was more canola leaving Canada for China and more beef and seafood products from Canada being imported into China. The work that we're doing on other sectors, including auto, is very constrained in the sense that we put a specific ceiling on the number of EVs that would be coming from China to Canada at about 49,000. So that is a very tightly structured agreement between Canada and China to resolve trade tensions. Our relationship with China, though, is broader than that set of issues that I just described. We are certainly elevating our relationship to a strategic partnership. We are cooperating in certain areas. For example, in the area of energy cooperation, in the area of people-to-people ties, and ensuring that the populations of our countries can develop and travel and see each other more frequently. Those are the types of other topics that are also on the agenda.
So would you welcome more Chinese investments, or is national security going to take precedence?
Well, we will always take the steps necessary to protect and defend Canada's national security. We are very clear about that. And so our relationship with China, like with other countries, is nuanced. We are going to always stand up for Canadian interests in the area of security, in the area of domestic protection of our populations and our democracy, standing against transnational crime, as well as making sure that our economy grows and we double non-U.S. trade over the next 10 years. So again, it's a nuanced relationship, and we must appreciate the complexities involved.
So as she said, it's a pretty nuanced relationship, and it's coming at a time when the Trump administration is hitting Canada with more tariffs as well. So that's why Minister Anand has said that she's prioritizing a trade-first sort of foreign policy. She's traveled to many countries, from Brazil to Pakistan to, of course, the ASEAN countries, reviving these old ties as Canada looks to increase non-U.S. exports, or double that in the next 10 years. So this is part of her trade diversification agenda, as well as she engages with the ASEAN countries and looks to sign this free trade agreement before the end of the year.
There in Manila. More ahead on the Asia trade. This is Bloomberg.
Here's the latest from the corporate front. Paramount shares closed higher in the U.S. after its $110 billion takeover of Warner Brothers won conditional approval from the European Union. The green light comes after both companies agreed to address competition concerns, but the merger still faces a U.S. lawsuit that threatens its progress over concerns the deal could harm competition in film and cable TV distribution. Texas Instruments fell in extended trade after the chipmaker reported second quarter results that beat the street but failed to impress investors. The company says revenue for the next quarter will come in around $5.6 to $6.1 billion, but it's confronting outsized expectations after a 70% stock gain this year. Brookfield Asset Management is buying battery storage operator IPA Power from Blackstone in a $7 billion deal. The transaction includes IPA's project pipeline, development platform, and 200-person team. The company has benefited from rising North American demand for power infrastructure tied to the growth of AI data centers. Samsung is revamping its foldable phones lineup just weeks after Apple is expected to make its first entry into the market. The Korean company is now offering 3 models with a mid-tier Fold 8 featuring a shorter and wider design that's better for watching videos and gaming. Take a look at how futures of Samsung are trading at the moment, pointing to some upside after the lower close in the previous session. We did have SK Hynix ADRs in the New York session, though, being supported. We had seen Alphabet's higher capex guidance providing perhaps some more dynamism to the semiconductor trade. I mean, if they're going to spend more, we could see some more of support for these picks and shovels for the build-outs. So we're watching these stocks as we're also watching these labor unions across South Korea rallying. This coming after earlier protests forced Samsung to pay bonuses of more than $400,000 to some employees. Workers at other companies are now seeking similar profit-sharing deals. Bloomberg Seoul Bureau Chief Kat Barton joins us now. Kat, so how widespread are these labor protests, and what's the significance of them right now for the South Korean society?
They're fairly widespread, actually. We have a very small protest happening at the Hanwha office right next to the Bloomberg office in Seoul. You can see them when you're walking around the capital city. But it's an interesting phenomenon because they're spreading not just through the chaebol, like Hyundai Motors, where there's been a partial strike this week, and Hanwha, but they've also moved to the big tech companies like Kakao. We had the first ever strike at Kakao last month. And even Naver, which is the country's biggest, internet search provider, they had a big, the union there is maneuvering to try and get a stronger negotiating position so that they can, face off better for a share of the profits.
I mean, we do have some other companies as well, like Hyundai Heavy Industries, Hyundai Motor, Hanwha Aerospace, as you mentioned, but at the same time, they're not necessarily these tech companies that are facing perhaps these huge gains in the semiconductor trade. So what is this issue really about? And what will it tell us about the future of how South Korean society perhaps faces artificial intelligence and automation?
It's a really interesting phenomenon because obviously it is stemming from, it's a spillover effect from these huge bonuses that we saw awarded at both Samsung Electronics and SK, where at Samsung, bonuses could be up to $400,000 US per semiconductor worker, which is huge. So yes, exactly as you say, even companies where they're not really dealing with artificial intelligence, the workers are starting to say, but how are we getting a share of these, increased profits, a share of increased efficiencies? Traditionally, obviously, bonuses tend to go to, C-suite executives. And now what we're seeing in South Korea is that workers are saying, we deserve a share of this. And it's something that the government itself has also been talking up. The government has started a debate about what do we do if we're getting huge excess tax revenues? How can we be sure that this is, shared fairly through all of society and it's not just going to a very few people? It's something the government is actively looking at. And certainly now we're seeing that workers across, many industries that are not traditionally involved in AI are also speaking up.
Yeah, and something perhaps that workers around the world will also take a closer look. Kat Barton, good to have you with us, Bloomberg Seoul Bureau Chief there. We have more ahead on the Asia trade. This is Bloomberg.
Macquarie Group CEO Shemara Wikramanayake will step down in November after 8 years in the role. The announcement comes with the Australian financial giant set for a tough shareholders meeting today amid fallout from a decision to hire a scandal-hit auditor KPMG. Let's bring in Bloomberg's Amy Bainbridge for more. So is a leadership change largely expected?
Look, investors we've spoken to this morning, Heidi, say yes. I mean, Shemara Wikramanayake has been in the role for 8 years. It is a very high-profile role in Australian finance. I've seen the CEO speak at countless conferences here in Australia. But she leaves with a mixed legacy. Obviously, there was a lot of, celebration at the time about a female leading a global bank. But there have been a string of regulatory breaches and issues under her watch. She will be leaving as the bank comes to one of its most profitable years on record. So in that sense, definitely coming off a high. It's a sprawling bank now, which, of course, is one of our major asset managers for our $4.4 trillion pension system here in Australia. But there is also personal banking. There's a big commodities trading business. There's many facets to this business. And Greg Ward, who is, must be said, a veteran of Macquarie, will be taking the helm in November.
So let's talk about this contentious AGM, right? What's going to be on the table today?
It's fair to say it was already set to be a pretty action-packed meeting. There's a number of things on the agenda. I mean, I feel like it's a little bit different to a year ago. There was far more scrutiny over pay. This year, the board is likely to face a range of questions, primarily around the appointment of KPMG as the bank's auditor, which isn't a contract that starts till 2028, and it will be voted on, that appointment, at next year's AGM, but there is set to be lots of questions. KPMG, of course, embroiled in controversy here over allegations of the misuse of confidential client data to bid for businesses in the Australian to bid for business in the Australian investment landscape. There's also been some reporting in local press around the culture in the division of Macquarie Capital. So there will likely be questions around that. There's some investors we have interviewed over the past few weeks who are really seeking assurances over the management of these kinds of issues. And then, Heidi, lastly but not least, of course, there's 2 resolutions on climate that are being put to the meeting as well today by one of the biggest pension funds, by one of the pension funds in Australia.
Amy Bainbridge there with the latest on Macquarie. The market opens in Sydney, Seoul and Tokyo are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens and the reaction after big tech earnings over in the U.S. Heidi, of course, we saw Alphabet raising their capex guidance again for this year. Tesla disappointing, the stock falling. What does that mean for suppliers across Asia at a time when we also have higher oil prices again because of the Iran-U.S. war?
So much for investors to be contending with, but as you say, the focus remains firmly on the next catalyst for this AI semiconductor rotation trade that we continue to see, right? It'll be very interesting to watch that dispersion when it comes to some of the Korean, Japanese, as well as Taiwanese players today and how that reacts. But you said it, Tesla was a disappointment, IBM was also a disappointment as well, and that could carry through to some more of that pressure on software names as well.
Yeah, we'll be watching a lot of those names across Asia, especially in Japan, with those tech semiconductor names, component makers, Kioxia, Tokyo Electron, Advantis, the likes. You can see the Nikkei right now gaining 0.4%. The topic's not doing much at the moment, but what we're watching is also the Japanese yen holding at that 163 level against the U.S. dollar. This is around a 40-year low against the greenback, despite the fact that Bloomberg has now reported that BOJ officials are actually looking into faster pace of rate hikes the markets had expected. Usually you would get a bit of a pop in the Japanese yen, which we really didn't get. It was a pretty muted reaction. Just comes to show you that we're seeing a little bit of a credibility issue with Japanese authorities, whether it's the Bank of Japan hiking rates faster or it's all of these warnings coming from the finance ministry about potential intervention in the markets. You're seeing JGBs at the moment with the 10-year yield holding at that 275 level. We've seen the 2-year yield yield now trading around highs that we haven't seen since 1995. It's not just higher oil prices, it's a cheaper yen as well, fiscal concerns, and you see this pressure on JGBs. Take a look at how South Korea is trading. Of course, we'll see the big reaction when it comes to those suppliers to the big tech earnings that we saw in the overnight session. We're seeing the Kospi a little bit higher by 2%, but this is such a volatile market, right? I mean, we're talking about volatility in the Kospi surpassing that of volatility in Bitcoin. The Korean won a little bit stronger against the US dollar. Do watch out for Samsung, up 3%. We have now seen there are 3 new foldable phones, so we have a new product lineup. SK Hynix, we had the ADRs in the overnight session supported. These 2 stocks were down in the previous session, so we're seeing a little bit of a rebound, Heidi.
Yeah, take a look at when it comes to what we're watching with the Treasury space, because Shery, you mentioned earlier, it's about these shifting expectations, about cementing expectations from what we get from the Fed, right? Certainly on the longer end of the curve, there's a lot of moves. A 30-year yield really raising the alarm as we see that longer streak above that 5% level since 2007. So we've seen 27 days above that 5% level now in 2026. This is really kind of reiterating investor concerns about growing debt burdens in the US, stickier than expected inflation as well. So that it is that watch when it comes to that sustained rise in longer dated yields, the fiscal picture in particular becoming a little bit more worrisome. We're also watching oil. As you mentioned, we continue to see the escalation. In fact, I think you could characterize as a broadening of the hostilities across the Middle East, because we had that confirmation from the Iran-backed Houthi militants saying that they targeted 2 Saudi tankers in the Red Sea, really threatening deeper supply disruptions beyond just the Strait of Hormuz and into a potential violation of a blockade imposed in the Red Sea as well. So we continue to watch from any kind of reaction from the US and Iran. Both sides have been downplaying a return to peace talks. So you see Brent crude there joining the trade up by 1.5% along with that rise in WTI. Here in Sydney, we're kicking off higher, 0.8%. One stock that we are watching is Macquarie, the financial name. A number of elements here, including a change in leadership there, with Greg Ward expected to take over as the next CEO. This coming at a pretty challenging time for Macquarie at the moment, with, of course, a sustained period of profitability for sure, but also scandals that have drawn some regulatory ire as well. This comes as we also watch the AGM today, with scrutiny expected from shareholders on account of the decisions made when it comes to KPMG, hiring KPMG Australia as its auditor, given the ongoing allegations now against that firm. Also likely to be questions asked about Macquarie's culture, senior leadership behaviour in the deal-making unit in particular. We've had a lot of local media coverage in terms of potential short coverings there. But we are very much front and centre watching the AI trade and how that permeates through the Asian session. These earnings from AI heavyweights looking for that catalyst, that surge in capital spending is translating into growth. Our Bloomberg Tech anchor Ed Ludlow has more on what Alphabet and Tesla's guidance mean for investors betting on AI.
Alphabet, the parent of Google, Tesla. 2 very different companies, but the story between them, capital expenditures and AI. Alphabet raised its capex guidance for 2026. At the top end, spending will be $205 billion. But there's also evidence that the AI demand for Google is real. Cloud revenues surged 82%. If there was an area of disappointment slightly, it was in search, where there was a modest miss against street expectations, but no evidence that search is being disrupted too much from consumers using chatbots instead of going to Google. Elsewhere, it was an assessment of growth versus cost, and investors weighing booming cloud demand against ever higher infrastructure spending. The next test, whether AI revenue growth goes fast enough to catch up with that capex demand. Tesla capex, it's going to stay at $25 billion for 2026, but the company is saying it will go up over the next 2 to 3 years. They're not even on track halfway through the year to meet the $25 billion capex guide, but Musk talked about the idea that they would rather move more quickly than target capital efficiency. The difference with Tesla is not the same evidence that in the world of AI, the future business lines, robotaxi, humanoid robotics, they don't have much to show for it yet. And so the appeal really was for patience, that these are still long shots with a big build out ahead. This is Ed Ludlow for Bloomberg News in San Francisco.
Let's dissect the big tech earnings from the U.S. and how that will really feed into the Asian session and bring in Vikas Pershad, Asian equities portfolio manager at M&G Investments. So, Vikas, really good to have you with us. We have a very nuanced AI trade right now coming from the U.S., right? When it comes to Alphabet, we saw this major cloud beat. We had Tesla disappointing. We had IBM cutting guidance. How does that necessarily translate into the Asian trade?
Good morning, Shery. Well, it's a good place to start. There are a few takeaways from the Google announcements for me. The first one is that the increase in capex should come as a surprise, but for those who are expecting the $750 billion to grow perhaps to $1 trillion from the big five spenders in the US for calendar 27 or maybe even early 28 on a 12-month view, we're probably not heading towards that number yet. So that's number one. Second, we've been investing not directly in the picks and shovels of the AI trade this year, but the picks and shovels of those picks and shovels. So what does that mean? Is that we're looking for beneficiaries or companies that will benefit even if the overall hyperscaler capex pool doesn't grow very much. So optical networking company, photonics-based companies, some of the advanced packaging companies, the underlying shifts in technology underway. That's what we're looking for in Asia, and there are plenty of opportunities still at this stage of the AI trade that we've seen over the past 4 years. Also, what I would say is that there's a lot of noise these days, but if you look back, let's say go back to April of last year when we had the Trump tariffs released across the world, there have been a few genuine signals. One of the real signals in recent months was last week or over the weekend with the Kimi K3 model. Our view is that there's going to be a divergence between compute and memory demand. Compute is going to become more efficient. And so we're revisiting our holdings in the memory sector, where we had been quite overweight last year. We have been overweight in more recent months, but we're revisiting that. So a lot to look at in Asia. But I would say that the overall takeaway is that we might see a deceleration in AI capex, hyperscaler capex, but that doesn't change the opportunity set for long-term active managers.
Yeah, it's very layered and nuanced what you're saying right now, right? I mean, if we see a slowdown because of what's happening across China, you will revisit memory, but at the same time, you're actually investing in the picks and shovels of the picks and shovels. So for investors who want to sort of unpack this, are there any regions or markets where you would find more opportunities? And when it comes to future investments, would you go into the Chinese tech sector itself as well, despite, of course, some of the more fundamental issues with that economy?
Yes. So to answer your last question first, whether an investor is looking to allocate more capital to AI and tech and hardware, or just the economy, the companies of the future, or if you just want to understand what's happening in the world, I do think that you need to start with China. The center of gravity of AI has already been shifting towards Asia over the past few years. That shift is accelerating, and it's moving from hardware and memory to now the models themselves. If you look at the recent announcements, recent being over the past year or so, first from DeepSeek in January, February last year, and now from Moonshot just a few days ago, the pace of the acceleration in Chinese tech development is astonishing, and that will have implications for all the sectors that touches. So yes, we're spending more time and we're allocating more capital to accelerators, GPU accelerators in China, to the semiconductor production equipment companies in China. And also all this capital allocation and the time and the research spent on China is yielding a lot of learnings for Japanese companies, for Taiwanese and Korean companies, many of whom are now more vulnerable than they have been in the past. So there is a shift underway in our portfolios, a little bit more caution on some of the North Asian names outside of China, and more constructive views on China. Despite the headline top-down slowdown that we are seeing, there's a very broad opportunity set in China, and it's not just about AI. Same thing goes for other markets. Japan, we remain very constructive, even though we're more than a decade past the launch of Abe's arrows. This might be the most slowly repricing equity story in the world, the corporate governance transformation in Japan. If we look at India, some stability in Q2 after one of the worst quarters for Indian equities in Q1. And there's a lot to like in India as well. 7,000 listed companies, almost 2,000 with a market cap over $100 million. Every sector you can imagine is listed in India. So the big three markets in Asia remain very exciting for us. If we've taken some capital away in recent weeks and months, it's been to the other large markets in North Asia, and that's Taiwan and South Korea.
Because do you think there's now a tech stock put in China with the national team returning with intervention?
It's a fair question. I would err on the side of saying yes. And so when we look at valuations in China, why are they so much higher now than they have been in recent years? It's because of the acceleration in tech spending. It's the acceleration of the progress that we're seeing. Coming into this year, the expectations for WFE, wafer fab equipment expenditures, was seen to be about $110 to $120 billion, with flattish growth or limited growth in China. 6 months into the year, we're seeing very significant increases to those estimates overall, but especially so in China. And so this is why the premia are expanding for Chinese companies. But it's not just scarcity premium. These companies are doing well, they're taking share. The Japanese and Taiwanese and Korean companies that we speak to, whether they are wafer companies, SPE companies, even memory companies, now acknowledge that there are vulnerabilities in their business models on a longer term view, whether it's DRAM, HBM or conventional memory, or NAND, or the etching and deposition equipment that in which the Japanese and the American companies have been leaders for a long time. So yes, start with China, spend time there, understand what's going on. And again, it's not just AI. Pretty much anything that is happening within China is touching sectors sectors outside of China, whether you look at healthcare, pharma and biotech, defense, aerospace, and then of course autos, ancillaries, renewables. The list is very, very long.
I guess the question is, when it comes to the broader landscape for Chinese equities, it's helpful to have national policy support, right? And of course, the national AI ambitions as well. But do you require a strong economic fundamental situation, which perhaps hasn't come through yet with the recent slowdown?
It wouldn't hurt. But if you look at our China strategies and our portfolios in China, the top holdings are not AI-related companies. It's a very broad opportunity set that we're seeing. We're seeing single-digit PEs, double-digit free cash flow yields, high and rising dividend yields, reasonable earnings growth, very smart capital allocation, much smarter than we've seen over the past 5, 10, 15, 20 years. And so our portfolio in China, the largest exposures are in banks, in shipbuilders, in some of the retailers. Yes, of course, we do have exposure to tech hardware, and we're doing our work on a broader universe of names as well. But the opportunity set, again, in China is very broad. For long-term active managers, this is the right time to look at China. If you look at China's contribution to global trade and the global economy on one side, there's a material dislocation between that and the allocation to Chinese equities in global portfolios. And we think that should normalize over time. And if it doesn't, it just extends the opportunity set for long-term managers like us.
And Vikas, before we let you go, just super quickly, I wanted your take on what we're seeing from the BOJ. Sources telling Bloomberg that they could actually consider going even at a faster rate when hiking rates. Would that alter your investment case for Japan?
Not really. We've seen the yen go from 100, or actually around the time of Abe's era being launched, around 80 to now 160. We don't, Shery, as you know, we don't invest in the market. We invest in stocks. We're not ignorant of the macro. At the margin, it might impact how we see some of the exporters, perhaps. But our view is if you do your homework and you bet on the right management teams with the right business models and the right unit economics, you'll win over time. But as you were mentioning just before I came on air, there is a credibility question. So we'll see how the market perceives this. They're being transparent. The headlines are out there, but the yen continues to weaken. So we do have our eye on that, but it does not change our long-term enthusiasm for Japanese equities.
Vikas Pershad, good to have you with us, Asian Equities Portfolio Manager at M&G Investments. Right, take a look at what we're watching across the Asia session. Of course, those tech earnings from the U.S. will have implications across Asia, especially across suppliers. We had higher capex guidance from Alphabet. Again, we had Tesla missing profit expectations. Some of those suppliers that we'll be watching across the day. This is Bloomberg.
Live from UN headquarters, a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. Organized by the Office of the President of the General Assembly with the support of Bloomberg.
We continue to watch the rise in crude prices as we had the Iran-backed Houthi militants confirming that they attacked 2 Saudi tankers in the Red Sea, really seen as a broader escalation of the Middle East conflict and threatening now deeper supply disruptions beyond just the Strait of Hormuz. We're seeing Brent crude online now by 2% higher. We're seeing that mirrored gains 1.5% higher for WTI as well. We have also seen that resumption of gains for European natural gas prices have extended that month's rally to more than 40% now, 0.6% higher when it comes to the last trade. We're seeing gas reserves in Europe just over 50% full, so that's down from a 5-year average of 70%. So clearly a lot of concerns playing out about price volatility going into the colder months as well seasonally. We've seen funds and other speculators also boosting net long positions in European natural gas, that strong conviction that potentially prices will continue to rise. That's the latest when it comes to this US-Iran situation. Our breaking news editor, Matthew James MacArthur, joins us now with more. We know that Iran is good at the waiting game, right? But President Trump also doesn't seem to be that hastened in terms of returning to talks or any kind of negotiating table.
Yeah, you're right. It's kind of been, as far as you can say, business as usual with regards to the U.S. and Iran situation. The U.S. military started their 12th night of strikes a little less than 3 hours ago, and it hasn't really escalated beyond that point. We haven't seen anything beyond military targets being hit, but we know that Trump has threatened to up the rhetoric a lot. He said that if Iran strikes a boat, he is prepared to hit bigger targets such as nuclear or bridges. So we're going to have to wait and see with the latest Houthi attack, as you've been saying. That poses a different sort of problem for Trump in that it's not, in a direct Iran attack on a ship in the Strait of Hormuz, but he had said before that he would take care of things, in his words, if there were any attacks by the Houthis. So we haven't seen a direct response to that. We don't know if the strikes that are ongoing right now in Iran are any sort of escalation. So we're just kind of in wait and see mode to see what happens.
This is clearly a consternation for Gulf allies, but we are seeing, I guess, a further strengthening of ties between the US and Saudi Arabia in the meantime.
Yeah, you're right. The U.S. Energy Department just announced that they signed a nuclear sharing deal with Saudi Arabia. This is kind of a big deal. It allows for the sharing of information and technology, could allow for American companies to build reactors in Saudi Arabia as well. So you're right. I think Trump's strategy in general is to use investment and money to strengthen ties with other countries. He's doing that with Saudi Arabia. He's obviously looking for different ways to strengthen energy. And he also supported a Syrian-Iraq oil pipeline to try to find a different way to get oil around it. So he's thinking of different ways to try to mitigate the impact of oil and energy prices on the U.S. consumer and oil prices in general because of the ongoing conflict with Iran.
Bloomberg DC breaking news editor Matthew James MacArthur there. And here are some of the other global headlines that we're following. A White House official has accused China's Moonshot of improperly using U.S. AI models and Nvidia chips to create its Kimi K3 system. Science and Tech Policy Director Michael Kratio says the company probably acquired Nvidia's GB300 servers, which are banned from being sold to Chinese companies. The information is reporting that a U.S. Commerce Department agency is now formally investigating whether Chinese firms like Moonshot are accessing advanced U.S. AI chips. China says it's ready to work with the U.S. to implement the consensus reached by Presidents Xi and Trump at their May summit in Beijing. The foreign ministry was responding to a Bloomberg request for comment on reported plans for AI talks in September ahead of Xi's planned visit to the U.S. Establishing a dialogue on AI was one of the outcomes of Trump's trip to China. The U.S. Senate Commerce Committee has advanced bipartisan legislation that would effectively block Chinese vehicles from the American market. The bill would ban vehicles designed for wireless communications beginning in January. Movement on the proposal, which also covers cars tied to Russia, Iran, and North Korea, comes as U.S. automakers face growing international competition. More ahead on the Asia trade. This is Bloomberg. Bloomberg's learned that some Trump administration officials are discussing using an external review of the 2023 failure of Silicon Valley Bank to provide legal basis to remove Fed Governor Michael Barr. Let's get the details from senior Washington correspondent Saleha Mohsin. Saleha, what are the implications of removing Governor Barr here?
Well, first of all, we're not anywhere close to it. What we have reported just now, breaking news from Bloomberg, is that the White House or Trump administration officials and allies see a current ongoing external review of the SVB bank failure in 2023 as providing one potential path to removing Barr. Now, the reason we are hearing these things is that President Trump has said publicly that he would like a, quote, majority on the Fed Board of Governors. And if Barr or if one governor steps down and Trump is able to appoint someone and the Senate confirms that person, then he will have his, quote, majority of governors who are aligned with his own economic thinking.
And at a time when we're seeing more efforts from the White House to reshape the Fed, what's the significance of this?
Well, what we've seen in the past 18 months is that first, the president went after, looked at Jay Powell, then chair of the Fed, to see if he could be ousted over the rising costs of building renovations at the Fed's headquarters in Washington. That did not work. There was a DOJ criminal investigation that was launched, and that did not actually force Powell out of his or find a way to get him to vacate his seat on the board. But there was also an effort last summer, and that has continued, to get Lisa Cook, a Biden appointee to the Fed Board of Governors, to be ousted over accusations of mortgage fraud before she joined the Fed board. And so if the Trump administration is eyeing Barr, goes after Barr, or finds allegations, that would be a third governor that they are trying to remove.
Senior Washington correspondent Saleha Mohsin there with the latest from D.C. We have more ahead on the Asia trade. This is Bloomberg. Broad upside across Japanese tech stocks, more than 3% at the moment, especially around anything related to semiconductors, anything related to components. Of course, we have seen the Alphabet's higher guidance for capex for 2026. Again, that could lead to a little bit more momentum for these picks and shovel stocks that are supplying and selling to all of these big tech giants. We're also following the Japanese yen. I mean, we have seen the incredible weakness around a 40-year low against the U.S. dollar. At the same time, we had some new reports that the BOJ perhaps might consider going faster than markets had expected. If you switch up the board, you can actually see what's happening with the yen. You can also see what's happening with JGBs, because the 2-year yield now at the highest level since 1995. For more, let's bring in our markets reporter, Anthony Stevens. Anthony, what should we be looking at right now in the Japanese market that's catching your eye? Because there's so much from the tech trade to the yen trade and JGBs.
Yeah, it's interesting actually just to touch the two things together, how the yen actually does help this tech trade, and it does help Japan remain competitive in the AI ecosystem, versus Korea, versus Taiwan, versus China, right? So this yen weakness is not exactly a very bad thing for the equity market, just first off. Secondly, it was very interesting to see the yen react to those BOJ kind of reporting. There was a little bit of an immediate strength, and that entire move was retraced over the course of the day. So the market is very skeptical that the BOJ is going to accelerate the rate hike cycle. It shows also within the rates curve where there is nothing priced for the next two meetings. So we have this real dichotomy in Japanese yen volatility. So after that headline, you had Japanese yen 1 month volatility fall. And as a result, the spread between the 1 year and the 1 month volatility is at the high end of the range. So what does that mean? It means that people think that the volatility in the yen is going to be backloaded to the back end of the year.
And it's not just about the skepticism about what Japanese authorities will do, right? It's about the fact of what everybody else around the world will do. I mean, if everybody starts hiking rates, what's to change here when it comes to that immense pressure that you're seeing on the yen?
Correct. And that's why some market commentators are just asking Japan to focus on yield control. So Deutsche Bank is out there saying that Japanese economic growth needs kind of anchored yields. And that is a much more important aspect of Japanese growth than the currency is. And there is some validity to that. You know, the growth that is being seen in the tech sector and in the export sector should benefit from a weak yen, whereas higher yields does raise the cost of capital for this economy. And it cannot afford that so early in the economic cycle to benefit from the AI boom. So which policy lever Japan tends to go with while the Takeuchi administration is trying to figure out how to supercharge growth, that is going to be the key debate in Japan macro in the back end of this year.
Wait, yield control, aren't we just going back in time at this point for Japan? I mean, and even can we, given, of course, that we have all of these other fiscal concerns as well in this country?
And that is a global theme, right? Like this theme of fiscal control versus yield control versus do people actually care about fiscal sustainability versus supercharging growth. This is a global theme where you have multiple actors that are racing to kind of gain these AI gains solidified and spread out those gains, and how much fiscal responsibility is possible in that environment. That is very much a big global debate. You have China on one side that is still trying to unwind some of the damage from its property bubble and cannot do stimulus, whereas in the US, Korea and Japan, they're in a slightly different position with a slightly expansionary fiscal belt. So as you identify, this is a very important back to the future moment.
Bloomberg Markets reporter Anthony Stevens there. Well, speaking of China, the big question is whether the national team, the pretty forceful intervention of ETF buying that we've seen, is here to stay, and we could see a repeat of that, right? Chinese investors certainly hoping that that resurgence of ETF buying will be repeated to keep that upward momentum that we've seen. Remember what we saw in 2024? But at the moment, we are also seeing that steady rotation from some pretty high-profile Chinese funds away from consumer stocks into AI. Names like Semiconductor Manufacturing International, some of the local Chinese semi names are really coming into favour as well. So we could see that booster returns, but it also has that vulnerability aspect, right, in terms of whether we see that volatility repeated in China that we have in the AI and chip space elsewhere. Well, White House official has accused China's Moonshot of improperly using American AI models and Nvidia chips to create its Kimi K3 system. It's the latest accusation from the US of possible IP theft by Chinese AI platforms. Let's bring our Chief North Asia correspondent Stephen Angle in Hong Kong. So, Steve, well, it's a good thing we're hearing that they're supposed to be talking about this before that September visit.
Right. Right. Of course, this opens up another front, if you will, in the differences between China and the United States, and difficulties, obviously, and whether they're going to go ahead and find some common ground in what we've been reporting over the last couple of days, of that the two sides will kind of get together and create a dialogue on the Xi-Trump consensus on AI, whatever that might be, ahead of the summit that is planned for September 24th in Washington. This adds a lot of complexity to it because, again, let me take a couple of steps back. When I'm talking about Moonshot AI of China, they really kind of upended the global assumption, if you will, especially from those in the United States, that Chinese large language models are well behind. They claiming their, as you just mentioned, the Kimi K3 model outperforms nearly all rivals except for Anthropic's Claude Fable 5 and OpenAI's GPT 5.6. And now, U.S. officials, we heard Scott Bessent yesterday say they are investigating whether there is IP theft involved. And now the director of the White House Office of Science and Technology Policy, Michael Kratsios, is accusing China's Moonshot AI specifically. Bessent didn't mention Moonshot AI specifically, but Kratsios is. And let's bring up the quote from him that he posted about what he's saying is a theft of technology through artificial AI distillation process. That's, to put it in kind of a nutshell without getting too technical, it's where a smaller, more efficient large language model will be able to train from the larger ones. And that's what they're saying. Even Bessent is saying they have found the digital watermarks on these Chinese AI models that show that they're potentially from America's proprietary AI models, like OpenAI, like Anthropic. So Kratsios says Moonshot acquired GB300 equipped servers and has access GB300s in Thailand, likely to train its AI models. So, as I said at the top, this opens up a whole nother front on the difficulties that these two sides are going to find at reaching consensus on governance, on everything AI related, if the U.S. is going to potentially sanction the Chinese for what they say is potential IP theft.
The dependency aspect is really interesting, isn't it, from both sides? But I do wonder, does this overshadow any achievements that we've seen at finding common ground when it comes to developing governance of AI? Maybe they should just recognize that clearly there's now codependence from both sides when it comes to this technology.
Yeah, so I guess we're going to have, they're going to work towards finding that common ground. Donald Trump definitely wants to go forward with finding and propelling this consensus. Again, we need details on what that consensus might be. But the Chinese are also now coming out and saying they also want to meet face-to-face with their U.S. counterparts to talk about this Xi-Trump consensus on AI. We're also hearing, to complicate things even further, on the first part of this report, essentially the information is reporting that the U.S. Bureau of Industry and Security, which is under the Commerce Department in the United States, is now formally investigating whether Chinese models accessed advanced U.S. AI chips. So, again, what consensus can they find when there's these allegations of theft and illegal or improper use of U.S. chips and the Blackwell architecture, which would violate those export controls by the United States?
Our Chief North Asia correspondent Stephen Angle there. Well, of course, as we watch Tesla suppliers in the Asian session in those disappointing numbers, SpaceX post-listing slump has soured the mood towards hyped-up IPOs in the US. Our Bloomberg Opinion columnist Shery Wren thinks that Chinese authorities are acting preemptively to stop the same thing from happening there. Shery joins us now with more. And, of course, this is just another facet of what we've seen in terms of what the national team might be trying to do to ensure support stays steady for some of these AI national champions.
Absolutely. It has everything to do with CXMT. CXMT is China's largest DRAM memory chip maker, and it's preparing to go public on Shanghai's chip-heavy starboard, seeking to raise as much as $10 billion US. What you're seeing is that Monday, the $10 billion, basically $9 billion payments were due from investors wanting to buy into CXMT's IPO. And on the same day, you see shadowy national team pumping billions of dollars into the market indexes that track the chip board. So it's very clear that the Chinese government is very worried how this mega IPO is going to drain market liquidity. There is also the concern about valuation. CXMT is going public at 2.4 times book, whereas the chip makers on the STAR index, they trade easily over 8 times. So investors were worried that this rally has gone too far. And what China is saying is that, don't worry, we have your back.
Is it a sure bet? Does that mean the chip rout is over if the national team has returned from taking breaks since 2024?
Well, I wouldn't say it's a sure bet at all. I mean, look at what happened 10 years ago, 2015, right? The national team came in again and again, and the market kept on tanking. At the end of the day, it depends on how much money the Chinese government is willing to spend, right? Like the market is quite big. China's stock market has become really big since 2015. So I think the chip sentiment is still very weak, and you are seeing it in yesterday's trading. The stock market opened high and went low again.
Bloomberg Opinion columnist Shery ran there with the latest. More ahead on the Asia trade. This is Bloomberg.
Canada and the United States have been close trading partners for decades and decades. We are bound together by geography. The Prime Minister spoke with the President yesterday, and they agreed to intensify talks relating to trade, and that will be undertaken by our Minister for Canada-US Trade and our Chief Trade Negotiator.
Canadian Foreign Minister Anita Anand speaking to us at the ASEAN Foreign Ministers meeting in Manila. President Trump has threatened additional 50% tariffs on Canadian goods over alleged unfair treatment of American alcohol, cars, and dairy. He's also expected to impose fresh tariffs on imports from dozens of economies by Friday, when the current 10% baseline global tariff rate is set to expire. Bloomberg Economics says most of the latest measures are unlikely to materially alter the overall tariff landscape, but the renewing uncertainty for several key trading partners. Let's bring in Deborah Elms, head of trade policy at the Hinrich Foundation. Deborah, always good to see you. I mean, President Trump keeps finding new ways to threaten tariffs. How expansive are these legal tools that are still available to him?
Very expansive. And so one of the things that we saw this week that was a surprise is reaching back into the toolkit from 1930 under what was then called Smoot-Hawley, that started part of the Great Depression, using a tool from that toolkit to apply to Canada, the U.S. largest and oldest ally, I think is a new twist in this trade and tariff saga driven out of the White House.
And you say that this Section 338, right, is now becoming live. What does this really say for other economies that are dealing with the United States then?
Well, it suggests that there is another much more powerful tool that many people had ignored because, again, it's never been used and it's been sitting there dormant since 1930. Under Section 338, which means Section 338 of this Act from 1930, as long as the United States can show that there was discrimination against U.S. companies or U.S. businesses, then the president is authorized to impose tariffs of up to 50%. With no investigation, there are really no procedures. The statute is indefinite. In other words, it doesn't come to an end. It's not a temporary measure. It's a potentially long-lasting measure. And the fact that the United States has now threatened it against Canada, I think means that it's now available to be used against every other trading partner whenever Trump gets aggravated about whatever aggravates Trump in the moment.
At least when it comes to Bloomberg Economics, when you consider all of these new tariffs expiring and coming alive as well, that the overall U.S. tariff rate might actually fall. Does that make the situation better, or does this just mean that we don't know where the trade war is actually headed, and we're going to see more uncertainty from here?
We are seeing more uncertainty, and I think we should expect even greater uncertainty through the rest of this year at least, and probably the rest of Trump's administration. And that uncertainty is actually in many ways more damaging than the tariffs themselves, because firms are not quite certain what they need to do. The processes to be used under each one of these different tariff rules is different, and so you need to make sure as a company that you are training your staff on what are the options, that they make sure that they keep the right paperwork, that there is a lawyer involved in order to sue if necessary or be part of ongoing lawsuits. I mean, the complexity just continues to grow. And I think for companies, that level of uncertainty, the cost attached to compliance continues to escalate. And so even if the tariffs themselves appear to be lower than they were, remember that heading into the Trump administration, it was a 2% tariff on average across the board. We're already closer to 20. And even if that drops to something, let's say 12 on average, the uncertainty costs, I think, need to be factored in as well, and the compliance costs. So it's not just the headline figure on tariffs, it's also the damage being done to companies who are trying to engage in trade with the United States.
And there's also really uncertainty about the time frame, right? All of these deadlines for different tariffs are different, excuse me. When it comes to the Canadian tariffs, is what, within a month. When it comes to the pharma tariffs, though, I was surprised that it was until 2028. Why are we seeing this divergence, and what is the Trump administration trying to achieve through this?
I think in some cases they want immediate application of tariffs. And so the one that is causing many companies heartburn right now is that tomorrow the U.S. temporary tariffs under Section 122 expire. And so the question is, what happens after that? Do they extend it? Do they make a new 122 case? They're trying to move people to a different statute altogether called Section 301. That hasn't been announced yet. It could still be announced at any moment. We're 48 hours away from switching tariff authorities potentially, or it expires and then gets reimposed under a new statute next week. The complexity is very high, and particularly for supply chain and procurement people, this is really complicated because it's not just what is the statute, but what does it apply to, what are the rules? In some cases, they apply to goods that are on the water. In some cases, they don't apply to goods that are on the water. I think you're finding supply chain folks who are just ground down after a year and a half of nonstop tariff and trade changes.
If experts can figure it out, I doubt the American public will be able to understand this. How much are they really getting from these tariff headlines that could make a material difference when we see midterm elections in November?
Well, trade never ranks high on voters' lists of priorities, but what does rank high is inflation figures and concerns about cost of living. And higher tariffs, uncertain tariffs, changing supply chains and market conditions do feed into tariffs, and those are the kinds of things that voters do see. So even if they don't immediately connect what's happening on this trade and tariff disruption to their own bottom line when they go to the polls in November, many of them, I think, will be thinking hard, much harder than normal, about the state of the economy and their own relationship in that economy. So I think it's an indirect effect, but trade will have an impact, I think, on elections in November.
When it comes to China, we have seen a little bit more consensus in Washington. We are expecting Presidents Trump and Xi Jinping to meet in September. What sort of breakthrough could we expect when it comes to the tariff front and the trade front? And have we seen anything meaningful in that relationship, given that a lot of it seems to have stayed in the back burner given the Iran war?
Yeah, I'm not expecting a great breakthrough, but there are some additional tensions that need to be navigated. One of them is, as we end this temporary Section 122 tomorrow and pivot to new Section 301 authorities, what happens to the relationship with China? China is currently being, like 60 other trading partners, being told that they will have to pay tariffs for failure to enforce rules on forced labor trade activities, but also they are in line for a second 301 with another 16 trading partners for what the U.S. calls structural excess capacity. And the two tariffs combined is an important figure that could easily derail any kind of cooperation at a summit next month, because those tariffs on China could escalate quite rapidly from what has been a relatively steady rate to a much higher rate, or potentially not. And again, we're uncertain where this is going to go, and I think the Chinese are probably also uncertain about where Washington will ultimately land. It looks like they want to have, that Washington wants to have stable relations with China, but because there are, again, a number of pressures, both tariff and non-tariff, that are ahead, I think it's unclear whether this relative truce can continue to hold.
Deborah Elms, really good to speak to you as always, Head of Trade Policy at the Hinrich Foundation. We have more ahead on the Asia trade. This is Bloomberg.
Asian shares broadly on the rise, despite some consternation when it comes to the AI and chip maker trade, with some major catalysts coming through for investors looking for really the next signs of whether we're going to see that enormous AI spend translate into being able to pay off. But at the moment, we are seeing some gains. The Kospi up by 3%. The Nikkei 225 also putting on 1.2%. Regional chip makers are gaining on these expectations that benefit from the billions spent in the build-out for AI will start to come in. Oil also extending that rally. That's benefiting some of these energy heavy gauges like here in Sydney. Take a look at some of the top corporate stories that we're tracking this hour. And Samsung is revamping its foldable phone lineup just weeks before Apple is expected to make its first entry into the market. The Korean company is now offering 3 models, with the mid-tier Fold 8 featuring a shorter and wider design that's better for watching videos and gaming. Texas Instruments fell in extended trade after the chipmaker reported second quarter results that beat the street but failed to impress investors. The company says revenue for the next quarter will come in at around $5.6 to $6.1 billion, but it's confronting outsized expectations after a 70% stock gain this year.
And take a look at how futures are trading as we're seeing a more risk-on session today. We continue to watch the tech sector after Alphabet's higher capex spending for this year. Do watch out for some of those tech names in the Taiwanese session as well. Also, stay tuned for a big conversation coming up tomorrow. Bloomberg's Avril Hong sits down with the Cambodian Prime Minister as well as other members of the Cambodian cabinet for exclusive interviews in Phnom Penh. They'll be discussing the country's border issues with Thailand, relations with China, and much more. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. The China show is next. This is Bloomberg.